If you didn't already know it, there's a big change to the way EV tax credits work in the United States, and it's already gone into effect. It actually went into effect August 16th, 2022. Let's talk about what the new legislation does, what it doesn't do, and how it might affect your purchase. Key things to know. Point of sale will happen eventually. So at the moment, you'll have to still file for the credit on your taxes, but going forward, eventually, you'll be able to have that credit deducted from the purchase price of your EV in the future. The cap of 200,000 units per manufacturer is gone, with a few caveats there. Fuel cells are also eligible for the credits, although no fuel cell theoretically is eligible currently because of some of the other things we're going to talk about. It also gets means tested now, and used EVs get a credit finally. Let's dive into the details here. First off, GM and Tesla vehicles will qualify. In fact, GM and Tesla are probably the biggest beneficiaries of this legislation because their vehicles are manufactured primarily in the United States. Exactly why some of this bill goes into effect immediately and why some of it's going to have to wait till January 1st, nobody really knows. But if you have purchased your EV or your plug-in hybrid before August 16th or have a binding contract on one, then you can still get the old $7,500 tax credit if you want it. And you're definitely going to want that on expensive EVs or vehicles that are not built in the United States or in Canada or in Mexico. Now, important disclaimer here as we're going to talk through some of these rules here. Not every rule is set in stone because the legislation has passed, but the rulemaking process at the IRS and other agencies involved, that has yet to start. So not all of the details have been finalized, and we're going to see further guidance around some of these details and some important questions here later on the IRS website, probably before the end of this calendar year. The key thing that has not happened yet is exactly how the point of sale credit is going to work. We know that that's not going to happen until calendar year 2024. So 2022 and 2023 purchases, you're still going to have to file for the credit on your taxes. 2024, you'll be able to transfer your credits to the dealer, and then the dealer will be able to apply for that cash back from the government. But exactly how that's going to function and how that all works, we don't really know yet because those rules haven't been done. But let's get to the nitty-gritty here. The requirements for which vehicles will qualify for the tax credit. The first and most important one is that the vehicle is going to have to be manufactured in the United States or in Canada or in Mexico. Starting August 16th, all vehicles from Hyundai, Kia, Genesis, Porsche, Polestar, and Jaguar and Land Rover are going to be ineligible for any kind of credit under this scheme because they're not built in North America. Now, before I go over the list of vehicles that are eligible, let's talk about the other important requirement here. Part of this bill was to encourage or guarantee that production and supplies of batteries and critical components start migrating to either the United States or countries that we have free trade agreements with. There's currently a list of approximately 20 countries. You can hunt down that list on your own, but some critical countries on the list include some key countries in South America where minerals are extracted, Australia, a big place where rare earth minerals come from, and South Korea where a lot of battery packs are manufactured. So we're going to have requirements starting in 2023 that 40% of non-mineral components must come from that list or from the United States. Obviously, Canada and Mexico are on that list as well. And that requirement is going to ratchet up every year until 2029 when it hits 100% of non-mineral components. When they say 40% of non-mineral components, they're talking about cost, not weight or volume, etc. Second thing, minerals. 40% of the minerals must come from this list as well. And then in 2027, that's going to top out at 80%. This is again based on cost, not on weight. Now, these requirements start in 2023. So we're going to have a weird window where for 2022, or at least part of 2022, vehicles built in North America with these components sourced outside of this list are going to qualify for the credit. But come 2023, that list may be further reduced, and exact details are uncertain because manufacturers, clearly like Ford and Tesla and General Motors, whose vehicles theoretically do qualify under this scheme currently, we don't know exactly how much of the batteries, minerals, or components, etc., are coming from this list of free trade countries at this point in time. They're probably going to have to disclose that publicly. It may simply be disclosed privately to the governments. That way they can be on the eligible list. Again, details a little bit sketchy there. But the list of eligible vehicles may actually drop significantly come 2023. The other big thing to know is that starting in 2025, no components of the batteries can come from countries of particular concern, according to this legislation. And that includes Russia and China. Russia, not so big of a deal, kind of understandable there, but China, that's a big deal because a lot of battery components come from China. And in order to qualify for this legislation, after 2025, nothing can come from China on the battery side. Let's go over the list of theoretically eligible vehicles according to the Department of Energy currently. Now, key thing to know, plug-in hybrids and EVs are on this list. No fuel cell vehicles, although theoretically they could qualify at some point. The max credit now goes up to $7,500 for everything, so it's no longer based on battery capacity. That could be a big win for some plug-in hybrids on this list, but it doesn't really change things for the average EV in America because they all get the full credit. Let's just roll through the list. We have the Audi Q5, the BMW 330e, and X5 45e. Those are plug-in hybrids. Also, the plug-in hybrid Chrysler Pacifica minivan, the Ford Escape plug-in hybrid, the Lightning pickup truck, Mach-E, E-Transit, and the Aviator and Corsair plug-in hybrids. Jeep's plug-in hybrids, those are built in the appropriate areas. The Nissan Leaf, interestingly enough, but not the Nissan Ariya because that is going to be built in Japan. The Rivian R1T and R1S. The Volvo S60 plug-in hybrid because that's built in the United States. The Mercedes-Benz EQS SUV is on the list. Also likely the EQE SUV will be on the list, but not the EQS or EQE sedans because those aren't built in the US. Also the Lucid Air. Likely out in the cold for the foreseeable future would be essentially everything from Hyundai and Kia at the moment. They may move some of their plug-in hybrid production to the United States, and Hyundai and Kia are planning on investing heavily in EV production in Georgia, but so far that has theoretically been supposedly new models, not their existing lineup. Exactly how that will sort out, we don't know yet. The Polestar 2, of course, the EQE and EQS sedans, the XC40 from Volvo, everything from Audi except for the Q5 plug-in hybrid, the Jaguar I-Pace, the Dodge Hornet, Alfa Tonali plug-in hybrids because those are built in Italy. Basically everything from Toyota that's a plug-in hybrid or an EV. Also Lexus, the upcoming EV there, and the Subaru Solterra because those are built in Japan. Also, interestingly enough, as I said, the Nissan Ariya, that's built in Japan, whereas the Leaf is built in the United States. Now, starting in January, the Tesla 3, X, S, and Y theoretically could be eligible, as also the General Motors Hummer, Bolt, and Bolt EUV. But there's an important thing to keep in mind. This new legislation has a maximum price cap, and that could reduce some of these vehicles. And the reason I'm including the Model Y and Model S is that we don't know if there's going to be a cheaper version of some of these vehicles in order to get them to qualify. The price cap is going to be $55,000 for cars, so maybe a discount Model S might squeak under that if they gave it rear-wheel drive and a really small battery pack. The Model X is going to be a little bit closer. The top for SUVs, pickup trucks, and vans is $80,000, so theoretically it'd be possible to make a slightly cheaper Model X and make it come in. But the Model 3 and the Model Y, they should be fine based on exactly what Tesla does with pricing around those particular models. Now, just because it's on this list doesn't mean it's A-OK. That's the important thing to keep in mind there. The other thing to know is that income testing will apply. So you will not get the tax credit at all if your adjusted gross income for a single person is $150,000 or higher, or $300,000 for a couple filing jointly. If you're filing head of household, then it splits the difference at $225,000. Now remember, this is adjusted gross income, so not actual gross income. This is after you've removed all of your deductions there. On the question mark list, we have the Volkswagen ID4. I suspect it will end up being just fine because Volkswagen is moving a lot of production for the ID4 in the United States to Tennessee. And those vehicles should qualify on the manufacturing front. Battery details, that's going to be a bigger question mark. The batteries are made by SK Innovation, which is a South Korean company, but I don't know exactly where the batteries and minerals are sourced from. Likely it's going to be okay, as long as you get your ID4 built in the United States. And that's where things are going to get a little murky here, because Volkswagen is currently selling ID4s built in the US and ID4s built in Europe in the United States. Some may qualify, some may not. You're going to have to use a VIN decoder to determine where your vehicle was built to see if it will qualify. Also probably okay, the upcoming Honda and Acura electric vehicles, because those are going to be built in a joint venture with General Motors in North America using the Ultium battery technology from General Motors, so those vehicles will probably qualify as well. Also, it is possible that the new Volvo and new Polestar vehicles will be okay because those are going to be built in South Carolina. Details are unknown about the content of those batteries. And Hyundai and Kia are investing in some new factories, likely in Georgia. They're probably not going to be coming online for another few years, however, but their larger EVs are going to be built in that factory, it appears, and they may qualify once those factories are up and running. But definitely some sketchy details here. Now, next thing to know is leases. If you lease your EV, and statistically a lot of folks are doing this, especially when we're talking about traditional luxury brands, then none of this applies to you because the tax credit never applied to leases. That's because the leasing company may or may not get the tax credit instead of you because they're the ones buying the vehicle and then they're leasing it to you. Here's why they may not get it. The company has to make a profit because this is a tax credit. So after you have done all your tax calculations and you've decided how much tax you owe, the business then can apply for the credits to reduce their tax liability. But if the company has no tax liability because they had a tax loss that particular year, and that can happen quite often for a lot of companies, then the credit does absolutely nothing, which is why a lot of car companies weren't offering any sort of incentive for leasing of electric vehicles, and why Ford got a little bit creative with the Lightning and the Mach-E sales where they had a Ford options plan, which is a sort of balloon payment thing where you're actually buying the vehicle, but they try and structure it sort of like a lease, so that way you still get the credit because Ford Motor Credit probably was not. Now let's talk about the used EV tax credit. I'm not the biggest fan of the way this section was written for a few reasons. First, it appears that you're going to have to buy your used EV from a car dealer rather than a private purchase. So private purchases appear to be excluded. The second thing is the price tag of the used EV. It has to be under $25,000. Currently, the average used EV price is pretty high. There aren't very many used EVs at all under $25,000, certainly not very many on dealer lots. So those two things mean that you're probably not going to find many EVs that qualify for this. It's going to have to be at least 2 years old, so no turning around your vehicle and still getting a credit. That sort of makes sense. The credit will be $4,000 or 30% of the EV's value, whichever is less. So if, for instance, you end up with a $10,000 EV on the used car lot, that credit would theoretically be $3,000. You'll get that instead of the $4,000 credit. In addition to the price cap on the used car, there's also going to be a different set of income testing applied. So $75,000 limit filing singly, $150,000 limit filing jointly. So much more restrictive than the new EV credit. Also, businesses will not be able to qualify for the used EV credit. That's definitely different than the new credit because that one applies to businesses as well. Over here, only individuals will be able to qualify for the used EV credit. The bottom line effect of this legislation is pretty controversial because immediately it has excluded a ton of electric vehicles and plug-in hybrids from tax credits, even though theoretically those manufacturers had hundreds of thousands of tax credits left. Now, on the other hand, it is certainly going to encourage moving production and sourcing of materials to either North America or that list of 20 countries that's approved on the material sourcing. So it's likely going to have a big impact on North American production and the moving of sourcing of those materials to countries with better mining practices and countries that are more aligned with the politics of North America. I'm okay with that in theory. I just wish that it had been done a little bit more slowly, perhaps a more gradual ramp up. Now again, if you're leasing your new electric vehicle, this probably doesn't matter to you because you never got the tax credit in the first place, and not every leasing company or car manufacturer would roll down that credit to you as a lease incentive because the leasing company or the captive finance arm, etc., may actually not get that credit at all. When you think about it, it's really logical because, for instance, the Audi Corporation in North America has only made a profit, a tax profit, 1 year out of the last 10. So only 1 year could they have made any benefit from those EV tax credits. The other times, they just went to waste. And that's why we don't really see that being applied to leases in general on a lot of new EVs. Lastly, as always happens with new legislation, there are a few things that we don't know yet because the rulemaking process is not complete. That happens after a bill is passed. For instance, we don't know exactly how the point of sale credit is going to function. And if it's based on a previous year's tax return, and this year you're not making as much money, so you would actually qualify under the income testing regime, but you didn't before, would you then be allowed to apply for the credit on your taxes rather than choosing the point of sale credit? Those details we just don't know yet. We also don't know yet what the impact of the sourcing requirements will exactly be on the list of eligible vehicles. And of course, we don't know what manufacturers will do as far as price points to try and keep their vehicles in the credit window. For instance, the F-150 Lightning, there are versions of it that will qualify because the cap is $80,000, but the top-end trims might not. The Rivian R1T will have versions that will qualify and obviously versions that don't. Same thing goes with the Hummer. Some of the less expensive versions that we widely expect to see at some point may qualify, but currently none of the Hummers will actually get the tax credit, even though they're on the OK list. Something like the Cadillac Celestiq, absolutely not. The Tesla Model 3, it sort of depends on what price point Tesla gives an absolute base version of the Model 3, because the cap for cars is definitely lower. This is also going to encourage a lot of car companies out there that might have been considering an electric sedan in the luxury segment or near luxury segment to perhaps call them a crossover or an SUV, because then you get that bigger cap. It's all going to have to wait until we see how it all sorts out to see exactly whether this was a good idea or not. But again, in theory, I'm personally okay with using this legislation to try and bring some of this development and manufacturing back to the United States or our close allies. I just wish it had been done in a slightly different fashion with perhaps more of a gradual fade-in, so that way some of our companies that are located in our close allied countries, namely South Korea, could have moved production to the United States in a more planned fashion. I know that some manufacturers felt like this was really sprung upon them very rapidly, most notably the Korean manufacturers, because they are planning on investing in electric production in the US. They just weren't planning on doing it this moment. They were planning on doing it with their next generation products. Let me know what you think about all that down there in the comment section below. And of course, stay tuned for updates, because this is something of a fluid situation as the rules are being written. Be sure and hit the subscribe button, comment down there, find our related videos. Find me at Facebook, Instagram, Twitter, all of those social places. I'll still have you next week.